What if I told you that your mindset is just as important as the stocks you invest in? Yeah, you heard that right. Most beginner investors fail, not because they picked bad stocks, but because they let fear, greed, and impatience control their decisions. They see a little dip in the market and their hands start sweating. They hear a hot stock tip at a party and dump their entire life savings into it. Listen, if you want to be a successful investor, you need to master your emotions and build a rock-solid strategy. You gotta be disciplined. In this video, I'm breaking down the biggest psychological traps that trip up new investors and giving you a clear roadmap to navigate the market like a pro. Let's break it all down. Alright, let's talk about fear. It's a powerful emotion, right? Especially when it comes to your hard-earned money. The market dips a little, a news headline screams about a recession, and suddenly your heart is racing. You're staring at your portfolio like it's about to burst into flames. This, my friends, is where panic selling rears its ugly head. People see their stocks dropping and they immediately assume the worst. They sell everything, locking in their losses, all because they're terrified of losing even more. But here's the thing. Market downturns are normal. They're like speed bumps on the road to wealth. Remember 2020? When COVID hit and the market tanked? People were freaking out, selling off their stocks for pennies on the dollar. What happened? The market recovered, like it almost always does. Those who sold at the bottom, they missed out on the rebound. They let fear make their decisions, and it cost them big time. Here's the truth. Time in the market beats timing the market. Trying to predict the ups and downs is a fool's game. Instead of panicking, have a plan. Know your risk tolerance. And when the market dips, don't freak out. It might even be a buying opportunity. Alright, let's talk about greed, or more specifically, its close cousin FOMO, the fear of missing out. This little devil whispers in your ear, telling you everyone else is getting rich quick while you're just sitting there. You see a stock skyrocketing, everyone's talking about it, and you think, I gotta get in on that action. Next thing you know, you're buying at the absolute peak, right before the whole thing comes crashing down. Remember GameStop? Back in 2021, it was like the hottest stock on the planet. Everyone and their grandma was buying it, driving the price through the roof. People who had never invested a day in their lives were suddenly throwing their life savings at it, convinced they were going to get rich quick. And then, just as quickly as it rose, it crashed. Those who bought at the top, they got burned. Badly. Listen, hype is dangerous. It clouds your judgment and makes you do irrational things. Before you jump on the next hot stock bandwagon, take a step back. Do your research. Understand the fundamentals of the company. Don't let the fear of missing out make you miss out on the bigger picture. Remember, slow and steady wins the race. Let's talk about one of the biggest secrets to building wealth: patience. Yeah, I know it's not the sexiest word, but it's the truth. See, most people come into the stock market thinking it's a get-rich-quick scheme. They're looking for that magic stock that's gonna turn their $1,000 into $1 million overnight. Here's the reality. Real wealth, lasting wealth, is built over time. It's about slow, steady growth year after year. It's about riding out the dips and staying the course. Think about Amazon. Back in 1997, when it first went public, you could have snagged a share for a whopping $18 bucks. Now, some people might have looked at that and thought, this internet bookstore thing, it's a fad, it'll never last. But those who had the vision, the patience to hold on, let's just say they're not complaining. If you had invested just $1,000 in Amazon back then, held onto it through the dot-com bubble, the financial crisis, all of it, you know what you'd have today? Over $1.5 million. That's the power of long-term thinking. Okay, before you even think about buying a single share of stock, we need to talk about building a solid foundation. Think of it like this. You wouldn't build a house on a shaky foundation, right? So why would you build your financial future on one? That's where your emergency fund comes in. This is your safety net, your financial fortress that protects you from life's unexpected curveballs. We're talking 3 to 6 months worth of living expenses, stashed away in a safe, liquid account. Now I know what you're thinking, but Graham, that money could be growing in the market, and you're right, it could be. But here's the thing. When you're investing, you want to be playing offense, not defense. You want to be focused on growth, not worrying about whether you'll have to cash out your investments at a loss because your car broke down or you lost your job. That emergency fund, that's your peace of mind. It gives you the freedom to weather the storms and stay invested for the long haul. Trust me, having that safety net in place will make you a much better, more confident investor. Alright, you've got your emergency fund locked and loaded, you're ready to start investing. But where do you even begin? For most beginners, I recommend starting with index funds. Think of these like the diversified all-star team of the investing world. An index fund tracks a specific market index like the S&P 500, which is made up of 500 of the largest US companies. Instead of trying to pick individual stocks, which can be risky and time-consuming, you're essentially buying a tiny piece of all of them. This gives you instant diversification, which is key to managing risk. And the best part? Index funds are incredibly low cost and easy to manage. You don't need to be Warren Buffett to get started. Plus, historically, the S&P 500 has returned an average of around 10% per year over the long term. That's the power of compounding returns working in your favor. So if you're just starting out, index funds are a fantastic way to dip your toes into the market and start building a solid foundation for your portfolio. Chapter 6. Don't put all your eggs in one basket. Why diversification is key. Alright, let's talk about one of the most important principles in investing: diversification. Now, you've probably heard the saying, don't put all your eggs in one basket. Well, the same goes for your investments. You never want to have all your money tied up in just one stock, no matter how promising it seems. Why? Because even the best companies can stumble. Unexpected events happen, markets shift, and if your entire portfolio is relying on the success of just one company, you're setting yourself up for potentially huge losses. Instead, you want to spread your investments across different asset classes, sectors, and even geographical regions. Think of it like building a well-rounded team. You want players with different strengths and weaknesses. So if one area is underperforming, the others can pick up the slack. This helps to mitigate risk and smooth out your returns over time. Chapter 7. Consistency is key: the power of dollar cost averaging. Alright, let's talk about a strategy that can take the stress out of investing and help you build wealth over time: dollar cost averaging. Now, I know you're probably sick of me saying this, but timing the market is incredibly difficult. Even the pros get it wrong all the time. But here's the beauty of dollar cost averaging. You don't have to time the market. Instead of trying to pick the perfect moment to invest a lump sum, you invest a fixed amount of money at regular intervals, no matter what the market is doing. This could be monthly, bi-weekly, whatever works for you. Now, when the market is down, you're buying more shares at a lower price. And when the market is up, you're buying fewer shares at a higher price. Over time, this strategy helps to average out your cost per share, potentially reducing your risk and boosting your returns. It's like magic, but without the wand and the pointy hat. Chapter 8. Tune out the noise. How to stay disciplined and avoid emotional trading. We've talked about the importance of mindset, but let's be real, staying disciplined in the face of market swings can be tough. One minute the market's soaring, the next, it's nosediving. It's enough to make anyone want to chuck their phone out the window. But here's the thing. Successful investing is more about managing your emotions than picking the perfect stocks. It's about tuning out the noise, the constant barrage of news headlines, analyst predictions, and hot stock tips, and focusing on your long-term goals. Remember, the market is driven by fear and greed. When everyone else is panicking, that's often the best time to buy. And when everyone's euphoric, that's when you need to be cautious. Don't let the herd mentality dictate your decisions. Have a plan, stick to it, and remember that slow and steady wins the race. Rome wasn't built in a day, and neither is a successful investment portfolio. Woodrow, master your mindset, master the market. So, are you ready to master your investor psychology and start building the financial future you deserve? Remember, the stock market rewards those who stay disciplined and think long-term. Are you an emotional investor, or do you stick to your plan? Let me know in the comments. And hey, if you found this video helpful, hit the like button, subscribe, and share it with others who want to learn more about investing. And don't forget to turn on notifications so you never miss an update. Like, subscribe and share for more stock market insights.